Imagine having a crystal ball that doesn't just, predict the future, but actually helps you understand the strategic heart of a company's financials. Well, that's kind of what we're aiming for today. We're taking a deep dive into MPS Ltd's Q1 FY26 results just announced on July 18th, 2025. And our mission here really is to cut through the numbers, pull out the key insights, and explore the strategies shaping their future. We're looking at their official presentation, the board meeting outcome, and the investor call details. Now, you might see headlines about muted revenue growth, and yeah, on the surface, that's true. But as we unpack this, you'll find a really fascinating story. It's about strategic shifts and some, frankly, impressive margin expansion.
Yeah, what's really striking is seeing that modest top-line growth alongside such strong bottom-line improvement. It immediately tells you they're making some very deliberate choices.
Exactly. So let's kick off with the core financial snapshot. Overall reported revenue growth was just over 3%. That's up to about 1.86 billion Indian rupees from 1.81 billion last year. And just quickly, for our listeners, a lakh is 100,000 rupees, a crore is 10 million. So these are significant numbers. But while that revenue growth might look, well, pretty moderate.
But this is where the plot thickens, right? Look at profitability, EBITDA. That's earnings before interest, taxes, depreciation, amortization. It jumped 22.5%. That's over 500 million rupees.
Wow.
And PBT, profit before tax, surged over 37%. PAT, profit after tax, also up strongly, 36.1%. Roughly 350 million rupees there.
And it's not just the absolute numbers. The margins improved too. EBITDA margin up over 4 points to 27%. PBT margin jumped, 6.6% to nearly 27%.
Yeah.
And PAT margin up around 4.6% to almost 19%. Even EPS, earnings per share, shot up over 36%. Seeing that, modest revenue, but profits jumping by a third, it makes you ask, what's the secret sauce? How are they getting so much more efficient?
That's the key question. And interestingly, a big chunk of it comes from other income. This isn't core operations. It's more like returns on cash, things like that.
Okay.
That line item soared. It went from about 20 million rupees last year to over 70 million this quarter. And that boost just flowed straight down, helping convert that EBITDA into PBT really favorably.
So it shows discipline beyond just the core business.
Exactly. Very tight financial management across the board.
Speaking of discipline, let's touch on operational strength. Headcount actually went up about 8.5% to over 3,200 employees. That's expected with scaling. But here's something they highlighted as a proud achievement. DSO, days sales, outstanding.
Right. How quickly they collect cash from customers.
It dropped significantly by 10 full days, from 55 days last year down to 45 this quarter.
That's huge for liquidity. It frees up a lot of working capital.
Definitely.
And on top of that, they have a really strong cash position, about 1.45 billion rupees, so roughly 17.5 million US dollars, and maybe even more importantly, zero debt.
Zero debt. That's impressive.
It really is.
Yeah.
So what does this mean for you looking at the company? It means flexibility. They can navigate changing markets, invest in opportunities, weather storms.
Yeah.
It's a very solid foundation.
Makes sense. And that kind of foundation lets you make bolder moves, which leads us nicely into their strategic realignment. They've changed how they report things this quarter. It's now market-based, focused on 3 segments for their Vision 2027. Those are research solutions, education solutions, and corporate learning.
Yeah, it's a shift away from thinking about products to thinking about firm-wide capabilities for specific markets.
It helps understand where they're putting their resources.
Exactly. It clarifies their strategy for each market.
Okay, let's start with education solutions. Honestly, when I saw these numbers, my jaw kind of dropped. Revenue soared by over 56% this quarter.
56%.
Yeah. And because of that operational leverage, EBITDA more than doubled. The margin hit 36%.
Incredible numbers.
But here's the kicker. This was entirely organic growth. Their last acquisition in this area was way back in 2018. How did they pull that off?
Well, management pointed to a few things. Strategic partnerships with big educational platforms, continuing ed institutes, global learning companies, plus onboarding some major new clients.
Okay.
They also mentioned favorable conditions like the focus on higher ed in the U.S. really helped drive that near 60% growth. It shows what focused organic effort can do.
Truly impressive. Okay, next up, research solutions. Here, reported revenue saw a slight dip, down from about 1.18 billion rupees to around 1.09 billion. But despite that dip, segment EBITDA actually grew by almost 10%, hitting over 400 million rupees. And the EBITDA margin expanded significantly, up to 37% from about 31%.
Right. So that immediately raises the question, how does revenue fall but profit go up?
Exactly.
It comes down to the intentional right-sizing of AJE American Journal Experts, which they acquired recently. They've brought AJE's annual run rate down from $18 million to $12 million.
Okay, a deliberate cut.
Yes, but crucially at much better margins. AJE hit 23% EBITDA in Q1, and they're targeting over 30%.
I see.
And get this, the core research solutions business, if you exclude AJE, that part operates at a 40% margin.
40%.
Yeah, and is growing organically at 10–11%. So they're sacrificing some lower quality revenue to boost the overall health and profitability of the segment. It's a calculated trade-off.
And looking ahead for AJU.
They're focused on expanding B2B partnerships. That's less than 10% of AJE now, so big potential. Also scaling a DIY AI platform and expanding geographically beyond China.
Sounds like that needs some patience, though.
It does. Partnership deals take time. They expect results more towards early next financial year, but they are seeing strong volume from existing clients thanks to AI and automation. And they mentioned a new high-growth stream, journal editorial office, and peer review services.
Oh, interesting. Leveraging their expertise differently.
Exactly. They actually have about 200 PhDs doing this for publishers now. It's moving beyond just language editing to helping researchers actually get published. That's a big value add.
Very smart. Okay, last segment. Corporate learning. This one saw a decline. Revenue was about 258 million rupees, down from 295 million. Volumes down 32%.
Yeah, a noticeable drop.
But again, similar story on margins. EBITDA margin improved to nearly 17%, up from about 13%. So what's the play here?
The focus, they say, is on innovation, differentiation, and just tightening the operational screws for long-term stability. They intentionally cut headcount in this segment by 30%. Dropped from 288 people to 202.
30% is significant.
It is. It's about optimizing workflow, improving throughput. Management said their priorities threefold: fix the operational base for margins, boost innovation, especially with AI tools, and focus on strategic growth.
Yeah.
So again, it's right-sizing for future profitable growth, not just chasing volume now.
And the innovation side.
They highlighted AI tools for clients' dashboards, bots, a Gen AI studio,
Okay.
plus new offerings like adaptive learning pathways, immersive simulations.
And despite the revenue dip, they're still winning business.
Seems so. They onboarded 12 new logos, secured some sizable projects, including a multi-million-dollar deal. The pipeline sounds strong. Their phrase was, building for resilience and not reaction.
That disciplined approach, trimming less profitable relationships, seems like a theme across the board.
It really does.
Yeah.
And it's clearly driving that margin expansion we talked about earlier. It's a shift in mindset.
Let's look quickly at geography and clients. North America's contribution bounced back, up to 51% of revenue from 45%.
And they expect that to go higher, maybe 60–65%, because that's where the higher margin education and corporate learning growth is concentrated.
Right. And the number of clients billed, excluding the B2C side, dipped from 514 to 404.
Which sounds negative initially, but connects back to what we were just saying.
Exactly. It reflects that discipline, exiting unprofitable partnerships to boost overall profitability.
It points to a healthy long-term strategy. Profitable growth over just chasing the top line.
Spot on. Okay, let's move into the final section. Forward-looking strategy and corporate governance. MPS announced some pretty bold restructuring moves. First, merging ADI BPO services into MPS Ltd. ADI BPO is the current holding and promoter company.
Right. So what does this mean in the big picture? It massively simplifies the shareholding structure. You get rid of an intermediate layer, which should enhance operational flexibility and strengthen the alignment with the promoters.
And crucially.
Crucially, it does this without affecting public shareholders or causing any dilution.
Okay.
And strategically, it removes some regulatory hurdles under current rules, basically clearing the path for future acquisitions or other inorganic growth. It's a cleanup that sets the stage.
That sounds like a significant simplification. What's the second restructuring piece?
That involves their overseas subsidiary, MPS Europa AG. Its shares are being transferred to MPS Interactive Systems Limited. So MPS Europa becomes a step-down subsidiary.
Okay, and the rationale there?
It's really about consolidating their e-learning business, bringing it all under one focused entity. The aim is a more unified, scalable, globally competitive platform. Should unlock operational synergies, revenue synergies too.
Streamlining governance for that vertical.
Exactly, making the corporate learning business a more cohesive, effective unit globally.
Makes sense. And beyond restructuring, they're clearly looking at growth. They mentioned a strong acquisition pipeline.
Yeah, 3 deals apparently at advanced stages,
What are they looking for?
primarily education and tech companies. The criteria seem to be at least $10 million in revenue and 15% EBITDA margins. They want businesses with market tailwinds, as they put it.
And funding these.
Well, their cash flow is strong, but they said they're open to taking on some debt if needed, up to about 1.5 billion rupees.
Okay.
And interestingly, the payback expectations have shifted. Remember, past deals were often distressed assets with quick 2.5-year paybacks.
Right.
These potential new deals are seen as growth assets, so the expected payback is longer, more like 3 to 5 years. They're vehicles for future growth, not quick turnarounds.
That signals a more strategic, long-term view on M&A.
Definitely. It's about value accretion over time.
And AI. Still a big focus.
Oh, yeah. It's a key lever. Mostly driving operational efficiency right now, like they mentioned, producing articles in minutes, which helps expand market share through competitiveness. But it's also enabling new product development and even some consulting revenue.
So it's hitting both efficiency and new opportunities.
Exactly. Management did say the new AI-driven revenue streams are small for now, but the efficiency gains are definitely real and helping margins and market share. It's a balanced approach.
Good to see that balanced view. And just before we wrap, worth noting their CSR commitment. They allocated 11 million rupees, about 110 lakh in Q1 for corporate social responsibility.
Supporting things like girls' education, mental health care, support for physically challenged and underprivileged children.
Yeah, good to see that focus extends beyond just the pure financials. So, wrapping this all up, MPS Ltd's Q1 FY26 results. They really show a company being quite deliberate, strategically trimming, realigning, investing for the long haul, not just chasing immediate revenue.
Yeah, it's a story of internal discipline, focusing on operational excellence, and having a clear vision, especially that Vision 2027 they keep mentioning.
It's a quarter that might look quiet on the surface revenue-wise, but underneath there is some deep intentional shifts happening.
Definitely. Building that resilient, profitable foundation seems to be the core focus right now.
Which brings us to our final provocative thought for you, the listener. Given all these internal restructurings, the strategic investments, this focus on profitable niches, how much better positioned might MPS Ltd be to navigate future market shifts? And maybe more interestingly, what kind of truly compelling, innovative learning company could it become as it keeps pushing towards that Vision 2027?
Something to definitely ponder.